Hello, everyone, and a very warm welcome to today's major markets update for Friday, December the 29th, 2023. I already would like to wish you a happy new year, a happy, healthy, wealthy, prosperous, good 2024. Whatever the market will give us, we will be ready for it. Looking in hindsight, I think we have been right on the money for most of the time for this year. Already in August, for example, we said we would be looking for a steep decline. In October, then, we said we would be looking for a rally potential to 4,800. Yesterday, we got to 47.94. Not a bad call. Now, question is the top in? Yes or no? Well, I hate to bust your buffers, but the bears have not even been able to push below the shortest term blue warning level. That would be 47 something, I believe, whatever it is on the SP 500, maybe a little bit higher. But on the hourly chart, we haven't even pushed below, I believe it was the low of this week. So, or last Friday's low, whatever it is, there is still no sign of a top in place. There is plenty of negative divergence. Things are extremely overbought from some market breadth perspectives. And still, even at all-time highs, the AD line has still not made a new all-time high. That is still a concern. Normally, in a healthy bull, the AD line will make new uptrend highs pretty much before the market will do. It will push the market. Has still not happened. That remains a long-term concern. But the bears have not been able to push any of the indexes, maybe except the IWM, which is below 202, below key critical levels to suggest that the top is in place. So it looks like somebody's at the top already, could be the IWM. Some are still climbing. So there is still room for more. We have not broken below anything. But as I mentioned yesterday, we're getting closer and closer to the topping zone on a bigger picture perspective, somewhere around S&P 5,000 between, I would say, 5,000 plus or minus 200. So you as a trader and investor should take appropriate action. Doesn't mean you should sell everything, throw everything in the kitchen out of the window. Not at all. Take the appropriate action that fits your risk profile. Raise some stops, take partial profits, maybe hedge a little bit, whatever you want to do it. But I always give a warning because in this market, there are old traders and bull traders, but no old bull traders. So always proceed with caution. Don't get the cheese eaten from the sandwich. All right, that's how we say it. Again, technically, we're closed between the 25th and January 1st. So market updates and emails will be sent out sporadically. That's why you got one yesterday. That's why you got one today. That's why we continued to give out warning signs. And today should be one of those warning days. Plenty of negative divergence, but remember, divergence is only divergence until it's not. This is our, I would say, objective Elliott wave count for the NASDAQ. Again, I have many charts and kind of many wave counts, but they're all the same within a impulse, so to say. But due to these small pullbacks, most of them not lasting longer than a day, the wave count is a bit open to interpretation, unfortunately. Would we have 2, 3, 4 down days, for example, for this green wave 2, it would be easier to assess. Would we have 3, 4, 5, 6, maybe 7 down days for this wave 4 with a clear B wave in between? It would be so much easier. But this is all we get: one down day, one down day. This is a down day. All right, this is a little bit down. So it's hard to assess the exact correct wave count. And if I follow 5 good Elliott wavers, I get, unfortunately, 5 wave counts. So that doesn't happen very often. Most of the time, they and I are pretty good aligned. So please be patient. This is the objective Elliott wave count. Technically, there are enough scribbles in place to consider the upside complete. Negative divergence, but divergence only divergence, so it's not Money flow, once again, extremely overbought, as we were here in mid-November, and we got some sort of a pullback. So we might experience some sort of a pullback. Also, this wave count, remember, I kind of borrowed this one from our friends at wavetrader.net, the ABC, nailed the top here at the 61.8% extension of wave A, measured from wave B. So it looks like potential top as well for this wave 5 in red. Okay, but we need to break at least below 14.7765. I could raise it maybe here to last Friday's low. Okay, let's put a tentative, very tentative then. There, this level here. This is really, I don't even know what color to give it. Let's just do it purple. That is very first. Okay, this is our very first warning low. Let's put it right there. And you will see most indexes have not broken below it. Okay, that's our very first warning level, because that is technically, I believe, the wave 2 or 4 low for this ending diagonal, which always, as I said yesterday, turn into a leading diagonal. We break above yesterday's high, we're going to go to 15, 16,000, right? In the subdividing wave 5 or 5, etc. Market always reserves the right to subdivide until it breaks below 14,765 on the NASDAQ. Now, this is the bigger picture wave count we've been tracking since the October 2022 low. And we were looking here ideally for a top at around 14,620. Since we bottomed here at the 76.4% retrace, a 5-1 relationship, which is quite common, we do that. Now, we also knew because the third wave reached 161.8, the fifth wave tends to go to the 200%. However, the fourth wave then tends to bottom at the 100%. Okay, the market doesn't have to be ideal textbook all the time. Instead, it went to the 76.4, and we got a crazy extended wave 5. Now, question is this all of wave B, or are we going to see a larger 4 and a larger 5 still yet to come? That I cannot answer. Again, plenty of negative divergence. Again, crazy overbought market from a money flow perspective. So it does suggest a pullback is warranted. And I must admit, we have now 5 waves up again from the low here made, I believe, late November. 1, 2, 3, 4. Okay, sorry. There we go. This one. 1, 2, 3, 4, 5. I'll show you that with some other indexes as well. So again, from here, we have, again, 1, 2, 3, 4, 5 waves. Now, this is the alternative, I would say. We've topped here for this green wave 3. We get a 4 and then a 5. Wave 4 ideally bottoms in this thick target zone, but it can be anywhere between 14,900 and 14,360. So depends all which Fibonacci extension the market chooses. The thick one is the 23.6 to 38.2% retrace. It's quite common, but since we've seen such shallow pullbacks, I don't know where it's going to go. I simply don't know. But again, we have plenty of negative divergence to content ourselves with, and that must be noted. And that suggests that a overbought pullback is prudent. Must say the money flow there is quite crazy. It surprises me, but hey, I cannot foresee everything all the time. And as you can see, we haven't even closed below the 10-day simple moving average. Okay, we haven't closed even below last Friday's low. So can still move higher. Okay, can still do. Let's go to the Dow Jones. The Dow Jones decided to continue to subdivide. Was this low here from last Wednesday, wave 4, and now this wave 5? It's possible. Then again, we had a very extended third wave, a very brief short fourth wave, similar to what we saw for this one, barely any pullbacks. Now, I wanted to point out that the MACD is now rolling over to a sell, similar to what we saw here in July, August. Extreme overbought conditions, similar to what we saw in July, August. Similar setup here. Okay. Again, history tends to repeat itself, but it doesn't rhyme. So the only thing I can go by are this one similar, reasonably similar setup. but we're still well above the 20, the 50, the 200 days. So there's still nothing bearish yet. We haven't even broken below the level here of 37,050, I believe it is. So that's the first warning level. Second, third, lights out below the October. Long way to go. All right, moving on to the NASDAQ 100. This is the hourly chart. And again, this looks like a leading diagonal or a ending diagonal, whatever you choose. Probably a ending diagonal, given that we're most likely in this green wave 5. The fifth wave of the fifth wave, let me add that. So this gray wave 5 tends to target somewhere around 161.8 to 176.4% extension. And that's exactly what we got. So let me add the target zone for that one real quick. So you can kind of get an idea of where typically and ideally this should top. So add that to the mark and we should top there. This is the ideal topping zone for this wave 5. So okay, so far so good. What happens when a diagonal completes? We get a swift, fast retrace back to its origin. Okay, and that's what we got. Now, the first warning level is of course then below this wave 4 low. Okay, that's at 16,700. The second warning level is below this second wave low, okay, which is at around 16,625. And of course, this whole diagonal cannot subdivide anymore if we go below last Wednesday's low at 16,550. That's our third warning level, okay? And this is, of course, on the short-term term. The shorter term is slightly different than, of course, the daily time frame, which again is different from the weekly and the monthly time frame. Now, I also wanted to point out that if this is wave 3 here, made last week, I believe on Tuesday, last week, then this wave 4 should normally have targeted anywhere between 16,215 and 16,465-ish. And we got not even close. That was quite a shallow wave 4. That's why I say in bull markets, the downside disappoints. And of course, the ultimate litmus test, I would say, is below the December 4. Then this whole rally is over, and we're going to go look for much lower prices. Lots of negative divergence on the hourly chart, but we haven't even broken below the first warning level for the bulls, which is at about 16,700. We need to break below that as the first warning. Second, below 16,625. Third, below 16,550. Okay, so bulls in that sense are still in control, but technically there are enough waves in place to consider everything complete. Now, I must admit, based on Fibonacci extensions, if the top is in 5 and 5 and 5, that it fell a little bit short of the ideal upside targets. But we don't have to get there, just as the fourth wave fell also short of the ideal target zones. On the daily chart, we need to close below 16,550 to suggest that the rally is complete. Again, lots of negative divergence, not on money flow. But there are enough scribbles in place since the October low to consider this rally complete. Okay, there are enough scribbles in place. Absolutely. Now, I dusted off a weekly chart, and this is the rally since 2020. And then the October low from last year would be a major 4, and this is major 1, as you can see here. And we have now completed a 5 and 5 and 5. Okay, so that's that 5 and 5 and 5. The red target zone, I haven't moved anything. The green target zone, haven't moved anything. So we could have enough waves in place to consider the rally since October completely done. Again, we need to break below a lot of warning levels to really make sure this is correct. So from a weekly perspective, as you can see, the first warning level, would then be in blue, right about, I would say, there. That is pretty much the first one. Okay, that's our first one. Let's actually move that to there. This would be about our first one, somewhere around there. Then our second warning level would be there. And then our third warning level pretty much here. As you can see, that is strong support resistance. And then, of course, the ultimate always remains. Sorry, I'm going to change it. So a little bit there. And then this should be somewhere around there. Okay, you can see differences. It's a little arbitrary, but you get the idea. Now, also from a simple closing of, not closing price, but simple corrective pattern, there looks like to be enough waves in place to consider wave 5 of 5, 5 of C complete. That we might have fallen short. It could happen, okay? That's why they often say don't bank on fifth or fifth waves. But once again, we've not even broken below 16,550. So I have no sign that a top is in place other than a potential. That's all I am not advocating, but communicating that there is the potential for a top in place. That's all I am communicating. I have no signs of a top in place. We haven't even broken below the minimum level, as I showed you for the hourly chart. Right there, 16,700. We have not broken below. Then we need to break below 16,550, etc., 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 because we can still do this 3, 4, and 5. Now I have it here in black. Okay, so we have the potential for a larger top. Okay, we have that potential. There are enough waves in place to consider a much larger top complete. We could still do a larger pullback and then another rally. Okay, it is still possible. Why? Depends a little bit on how do you interpret the price action here. I have it here as 3, 4, and 5. See this versus 3, 4, 3, 4, 5. Okay, that is the difference. How you interpret this. So from a FIB perspective, this fits a little better. Consider where this green wave 4 bottomed. Consider where the gray wave 5, gray wave 3 topped. And again, there should we see a pullback here for this wave 4 and then a wave 5. Now I have it here red 4, red 5, and here I'd have it black 4, black 5, a little bit potato, potato, but you get the idea. Here I am pretty much off by 1 wave degree. Okay, that one versus that one. Now, similar to the NASDAQ 100, we could still see a 4 and a 5. This green wave 4 could bottom here, then a wave 5. That's why we need to also break below 16,195, because that's a sign that this green wave 4 is not going to happen. It starts to become a little too deep. It's not impossible, but it is a next warning sign. So once again, we've not broken below even the simplest of warning levels, which is blue. We have not even seen a weekly pullback, which would be 2. We have not broken below any of the second or third warning levels. So we could still do 3, 4, 5, 4, 5, but I'm not going to count too much in it. Again, lots of negative divergence. Looks pretty complete. That's what I'm pretty much trying to communicate. It looks complete. And again, it's many interpretations, but once again, that is so easy to have when the pullbacks are rather non-existent, and most pullbacks are just for 1 day. Now we have 2 days in a row that are down, so it does tend to suggest there is a shift in trend, okay? But not even the most critical level has been broken, which is 60,700 on the NASDAQ. So we have potential for a much larger top being in place, okay? We have that potential. But we have not broken below any levels that suggest this is the case. But we have the potential. I can count it that way. 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 5, 4, 5. Okay. Also on the daily time frame. 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, 5, 5. Potentially a 4 and a 5. Okay. As I said here in red, 4 and a 5. It is possible. It is still possible. Alternatively, we get a smaller 4 and a smaller 5, then a 4, then a 5, etc. And we'll repeat the whole process. That's why we have these warning levels in place. This green 4 becomes questionable below 16,195. That's the whole point. First things first, below last Friday's low at about 16,700 starts to suggest that at the best, this green wave 4 is underway. At the best for the bulls, this green wave 4. If we go below 16,550, green wave 4 is confirmed. However, we go below 16,195, green wave 4 then becomes questionable, completely off the table below 15,695. And then we're going to switch to, are we going to get this 1415 versus all of this is in place? All right. So those are the three alternatives you're pretty much looking for. Very simple. And we know it based on these price levels. So you should then take appropriate action on what are we going to do? Are we going to bet on this 4-5? Are we going to bet on this 4-5? Or are we going to bet on this one? I cannot tell you which one it is. This is my limit of analysis. This is the limit of Elliott wave. But I do know for all these indexes, these price cutoffs that tell me that odds start to increase, we will not see the green 4-5. The odds start to increase, we will not see black wave 4, black wave 5. Okay, that's beauty of the Elliott wave using these price levels. All right, moving on to the semiconductors. Now the semiconductors had to close below 41.50. Today we got as low as 41.55, kind of shows you how important the level is. We haven't even broken below the 10-day moving average. Ideal upside target is this target zone. We haven't even reached it, but it does start to look quite toppy. Okay, so this is the classic 3-4-5 setup, I would say. We have enough waves in place to consider this whole rally complete. Okay? Everything. Remember this chart I showed you, the monthly time frame. We have now made a new higher high. If we now start to close lower on January, we'll have more negative divergence to contend ourselves with on the monthly time frame to suggest that indeed this 5-5 of cycle 3 or super cycle 3 is complete. 5-5. Okay, please keep that in mind. Again, we haven't even broken below 41.50, so I can't say the top is in place. Not even below 4,000. Not even below 36.40, let alone below 31.50. Not until we go below 31.50 can I say, all right, the larger top is in place. But by the time you get there, I think you should have already taken way more than appropriate action to make sure there's no havoc to your portfolio, all depending on your risk, all depending on your time frame. Okay, it all depends. I cannot tell you because I don't know. Hundreds of people, I don't know what you want, and it's hundreds of people and thousands and millions of people that make the market. So everybody has their own wishes and desires, so to say, their own risk profile, their own investment strategy, their own investment time frame. Some is minutes, some is days, some is hours, some is weeks, some is months, some is years. Who knows? Other are decades, other never sell. Anyway, this is then the yearly chart I showed you for the semiconductors maybe last week, that this would count very well as this 3 and then a 4 and then a 5, which matches very well with this 4 and then a 5, right? Depends all on how you want to wave count everything. You label this cycle 1, cycle 2, primary 2, major 1, major 2, potato. But it does suggest we have reached or are reaching a much larger, significant top. So that is that covered. And let's move on to the S&P 500. Also here we have a pretty nice diagonal. Also, this diagonal topped exactly in this ideal wave 5 target zone this week. And what happens when the diagonal completes? We get a swift retrace. So far, so good. Okay. But we have not even broken below 47.35. That is the minimum level on this very short time frame to suggest the top is in place. So this can still subdivide. This can be 1, 2, or this could be 1, 2. All right. I don't know. There's many ways to interpret a diagonal. Maybe this is 4, and we're still going to 4,800. I don't know. That is the problem of diagonals. They can continue to subdivide 1, 2, 3, 4, 5. Technically, we've done enough. Okay. Now we are in a counter trend bounce. So far, also, I wanted to point out what has the Santa Claus rally done for us. So far, we're up almost 0.6%. Okay. That's about the Santa Claus rally we've had so far. Over the last 5 days, up 0.6%. It's nothing to write home about. Why? Because the Santa Claus rally, on average, is only 1.34%. So far, this rally is underperforming, but we have 2 days left. This is the last trading day of this year, and then we still have this January 2nd, 3rd left. So we can still add a little bit more, But again, we have not even broken below the most minimum downside target, 47.35. However, as you know, our long-term target for this upside was then 4,800. Printed it many, many times publicly. Can we reach 4,800? Well, we got to 47.94, something like that. It is awfully close. Awfully close. That's all I'm saying. Again, if the topping zone is somewhere between 5,000 plus or minus 200, you know where we currently are in upside reward versus downside risk. We nailed here the 161.8% extension. And technically, since the October low, there are enough waves in place to consider this rally complete. Okay, 1, 2, 1, 2, 3, 4, 3, 4, 5. It is very possible that this is complete. On a daily time frame, we need to close below at least 46.95. On the hourly time frame, at least below 47.35 and 46.95. Right? Those levels remain the same. Then below 46.10, 45.35. So the question is this all of wave B, or are we going to see a 3, a 4, and a 5? Potentially, just as I showed you for the NASDAQ 100. And that will still target somewhere around 5,000 plus. A larger pullback, and is this happening? Now, the ideal upside target for this wave 5 would be 48.19, 48.83, but it might have failed, and this is all we got. However, we can still subdivide, as I mentioned. We need to break at least below 47.35 to start to suggest we're not going to subdivide with confirmation below 46.95. So again, I'm showing the potential for a top. We have negative divergence on the RSI5, on the MACD histogram, on the money flow. There's enough, but divergence is only divergence. So just pointing it out. This is the weekly chart we've been tracking for quite some time that had us in a topping zone around 47.48 and 48.02. So far, so good. We still have negative divergence to content ourselves with on the RSI 14 and the money flow. Okay. So this is technically enough for this C of P. What did we get? Then we have a irregular B wave. What does this mean for this C wave? If we're going to get a C wave, that it will be either a regular flat, it can be a running flat as well, but C will not reach as far. But let's say this is what we got, okay? Then this wave C should reach here. Anywhere there. I can't make it any different. So this is then wave C of A. Originally, we had planned for, so to say, a B wave that would stall somewhere around, I would believe it was 4,300 to about 4,400. I believe we said 4,400 plus or minus 100. Now we got 4,800 almost. And that was already October last year. Does it mean we suck at what we do? No, that is still an amazing, fantastic forecast. Why? Because we start off with a standard retrace pattern, which is about around 62%, anywhere between 50 to 76.4% retrace. So that's around 4,400 plus or minus 100. Now it seems we might deal with this irregular B wave of a flat cycle A. Then we get cycle B and cycle C. Okay. The cycle A is 3 waves, and 3 waves are a zigzag, a flat, or a triangle. Either of the 3. Cycle A doesn't have to be a zigzag. That's what we start off with because it's the simplest of corrective patterns. And then we eventually anticipate that, we monitor it and see, well, that simplest of pattern morphed into a more complex pattern. And again, there are enough waves in place to consider all of these waves 5 of C of B complete. Please keep that in mind. That's all I'm pointing out. The most bullish alternative is that we indeed topped for 5 of 3 in green. Okay, for this accelerated bullish wave count, we're going to go back to about 46.50 plus or minus 25 for this wave 4. We can. This is the ideal green target zone in thick green, and then in thin green is as low as it can go. So we can even go to 45.60 if it wants to. Okay, so that's why we have these warning levels. Below 46.95 is the first warning level that green wave 3 has stopped. Hourly chart 47.35. We haven't even broken it. right? Not even close. Again, lots of negative divergence, but that can last for quite a while before it finally kicks in. Below 46.95, green wave 4 is confirmed. We go below 45.60, then there is no green wave 4. In my humble opinion, it's going too deep. And then we might need to consider that we indeed have topped for this one. Or alternatively, as I showed you, we're going to get one more 4 and one more 5. Okay, it is still possible. Please keep that in mind. Have reached the ideal topping zone for this extended B wave. October last year, we were already looking for about 4,300 to 4,500. I think we had it on the chart. Can the S&P right 500 reached 4,300? Now we reached it. We've exceeded it, so it is possible for irregular B wave. Okay. Alternatively, we'll get one last. Let's see here, gasp higher, 4, 5. And then we start all over again. So we have our cutoff levels. So if you so desire to go long here for this green wave 4 or 5 setup, then you know below which level this green wave 5 is not going to transpire. Again, this is our bigger target zone, anywhere between 46.93 and 5,026. Okay, so getting awfully close. This is the monthly time frame, and I want to point out this negative divergence on the RSI 14 that has been in place since 2018. It shows you how long negative divergence can last. So we're moving higher and higher on less and less strength. Same here for the MACD. You see this little wave here. This is what I penciled in a long time ago. And this is kind of what we got. Also, the money flow, as you can see, is not really very strong. This is the monthly time frame. So we've been moving higher on less strength, on less money, and less momentum. But we have not seen any reversals yet, and we're not broken below even the lowest minimust of levels. IWM. I think the IWM is a little cleaner and clearer. Topped here for gray wave 5, in my humble opinion. So now we're in green wave 4 and not a green wave 5. That's the ideal. Okay. But again, below 195 starts to suggest we won't see this green wave 5. Below 187, another serious warning that green wave 5 is not going to happen. And ultimately, of course, below the October low for everything else means this larger B wave is complete. Let's look at market breadth. Again, the AD line has still not made a new all-time high. It did break above at last these downtrend lines that have been in place. So that's great. And we have a higher high compared to August. So that is also great. So that are the only two confirmations we have. But as you can see, we have, of course, pretty much higher prices here, there, versus that. That is not a long-term healthy sign. It can always change. But remember, by the time the indexes in 2020 broke above their crash high, right? Before the crash happened here, the AD line was already making a new all-time high. And that we've not seen. See the difference? This versus this, right? Break even, break even. The market went break even and the AD line was already way ahead. We're now break even and the AD line is not ahead. That is a concern. The other one, as I've hammered on many times, is the ratio of the percent of stocks above the 50-day moving average divided by that of the 200-day moving average. For every bull since, I believe, 2003 or something, had a spike from below 0.2 to above 1.75. We haven't seen it. Even bear market rallies had that. So this also suggests this is a weak initiation that should peter out. Here is a buy versus sell indicator based on the NYSE McClellan oscillator. If it goes above 0, you buy. If it goes below 0, you sell or short. So far, it's still above 0. I don't know what today's reading is, but this one would have kept you in the market for quite some time since late October, as you can see. There's some false signals, of course, but no indicator moves all the time. But so far, it's still positive, and as long as it's positive, we must give the benefit of the doubt to the. This is the McClellan oscillator for the S&P 500. I don't know what today's reading is, but yesterday, etc., it was still positive, so the bulls are in charge. Now, here is a chart that kind of shows you sometimes uselessness of historical studies. The RSI5 of the summation index reached 96.43. That's the highest reading since data is available in 1998. So we have now about almost 25 years of data. This is the highest reading. So what does this tell me? Nothing. I have nothing to compare anything with. Then we can say, for example, well, we're going to loosen a little bit the requirements, anything above 90. Well, then you already start to dilute the data pool with worse data. You want high quality data. The looser your requirements, the less strict they are, the more bad data you're, of course, going to catch. It is like asking people that have bad income, bad credit ratings for a mortgage, right? So to say, they want to apply for mortgage. That's why we got the mortgage problems in the early 2000s, because more and more people that should not have a mortgage got a mortgage. Why? Because you're loosening the requirements, and then bad data comes in. And this is then what you get. So I have nothing to compare this. This also brings me to those often historical studies that we see. All right, if the market does this, what have we seen over the last 100 years? Every single time they find that the longer we look, the higher the market goes. Always bullish outcomes. Why is that? Well, long-term, the market trends higher, always. Bear markets last maybe a year, sometimes 2 years, and that's about it. So if you're going to look 3-4 years out, you not most of the time will have higher prices. Okay. So here in 2000, okay, we had a bear market for about 2-3 years. Depending on where you start, here in 2001, 2004, you're almost back to breaking. 2008, fantastic, right? Bear market, and 3 years later, you're already, etc., etc. So the longer you're going to look out to these historical studies, you always find the market goes up. And shorter term becomes more and more random. So the only thing you will catch is the intermediate term. How is it going to look over maybe 2 years, weeks to months? That's the only significance. The rest of these type of historical studies are not really useful because you're analyzing something that's trending higher anyway. So what you need to do is detrend it. That's pretty much what you need to do. And then, of course, the whole thing falls apart because then we don't know where the market is going. But that's the only way to, of course, analyze trending data. Stock market trends higher on average. It gains 10% per year. That's the average gain. So you'll always find the longer you go out that, yeah, see, the market goes up. So just stay invested, the market will go up. Stay invested, the market will go up. Yeah, that doesn't tell me anything. That is the general nature of the stock market. So please keep that always in mind with these historical studies that, A, if we have now reached an extreme that has never been recorded before, pat yourself on the shoulder. You have experienced something that has never happened before. That's quite unique. 2, I cannot do any historical comparisons because I have nothing to go by. 3, I can loosen the requirements. That will mean I will get worse and worse data that are less and less relevant for my study. So I'm not even going to do it. So it won't help me. 4, historical studies always find that the longer we look forward, the most likely the market will be higher because we're dealing with a trending market that goes over the long term higher. Compare that where we are 10 years ago, 20 years ago, 30 years, 40, 50, 60, 100, etc. Compare it even to where we were 2 years ago, etc. Okay, so those market studies don't tell us a whole lot. Last but not least, also the PMO buy-sell indicator is, of course, in its topping range, right? This is quite toppy. Please keep it in mind. At the top end, we're not at the low end. This is the low risk zones, right? This is where we have low risks. We're now at high risks from a long point of view. Market sentiment, well, active money managers are overexposed to the market, 102%. I have data available since 2006, so it's not too much. And if you look at what happens if we're above 102, you can see the occasions. All right, sometimes we're close to a top, oftentimes we're also not. So it doesn't really conclude too much. Right, we're close to a top here, we were close to a top here, close to a top here. Also not close to a top, definitely not close to a top. So again, doesn't tell me too much. I do know that bullishness is quite extreme. Okay, we're extreme greed. We were extreme greed yesterday. We're extreme greed a week before. And again, nothing goes up forever. And bullish sentiment from AAII. It is not the same as the NAAIM. This is active money managers, and this is mom and pops that are investing, is around normal, still reasonably bullish. Okay, from a contrarian perspective, this is bearish, but it is not a slam dunk. Most of the time, extreme low readings are much more reliable bottoms than tops. Okay, fear is really like a one-day event. That's it. Boom, and we bottomed. But tops can take a long time as we are wrapping up these third, fourth, and fifth waves to finally complete the impulse. So please keep that in mind. They are contrarian, but again, we've been extreme greedy for a week now. We've been greedy for a month now. So, and look where we are compared to a month ago. So it's not a slam dunk signal. It's just like a third tier data point. That's all I want to say. So bottom line is we start to look more and more toppy. We have reached for several indexes our bigger picture target zones, but I have not the slightest, singlest indication that we have topped, because we have not even broken below the highest minimum level to start to suggest that a top is in place. So thank you so much for a great year. I'm looking forward to 2024. I'm also thinking it's going to be a great year. And what we've experienced over the last 2 months will definitely not continue for another 2 months. That I'm pretty convinced of. Take care, trade safe, Happy New Year.